Welcome back to John Smith 02. I'm John Smith, and today we're looking at a question that has become impossible to ignore. The Doha peace talks have collapsed. Iran has launched a ballistic missile strike on a United States military base in Kuwait. The Strait of Hormuz has been completely closed. Energy markets are under pressure. Global shipping routes are being re-evaluated. Governments around the world are monitoring developments hour by hour. And yet silver prices remain near $74. For many investors, that number seems surprisingly low. When people hear about military escalation in the Middle East, threats to global energy supplies, and rising geopolitical uncertainty, they often assume precious metals should already be moving dramatically higher. But that is not what we are seeing. Instead, silver appears to be sitting in a strange position. It is elevated compared to where it traded a few years ago, but many analysts believe it has not fully responded to the scale of the risks now facing the global economy. So the question becomes simple. Is silver accurately priced for the world we are living in today, or is the market still underestimating what could happen next? To answer that question, we need to understand why the recent events matter, why silver is different from most other assets, and why a growing number of market observers believe the metal could be approaching one of the most important repricing periods in modern market history. Let's start with the bigger picture. Financial markets do not operate in isolation. Every day, billions of decisions are made by businesses, governments, manufacturers, investors, transportation companies, energy producers, and consumers. All of those decisions connect together to form the global economy. Most of the time, people only notice this system when something goes wrong. Think about electricity in your home. You rarely think about it when everything is working normally, but the moment the power goes out, you suddenly realize how many parts of daily life depend on that invisible system. The global economy works the same way. Most people never think about shipping routes, energy transportation networks, supply chains, or industrial inventories. But when those systems face disruption, the effects can spread everywhere. That is exactly why the closure of the Strait of Hormuz has become such a major concern. For decades, the Strait of Hormuz has served as one of the most important transportation corridors in the world. A substantial amount of globally traded oil moves through this narrow waterway. Energy producers rely on it, importing nations rely on it, shipping companies rely on it, financial markets rely on it. When that route becomes unavailable, the consequences extend far beyond one region. Imagine a city where millions of people depend on a single major highway. Every morning, trucks deliver food, fuel, and essential goods using that route. Then one day the highway closes completely. Alternative roads may exist, but they are less efficient. Transportation becomes slower, costs rise, deliveries are delayed, businesses begin making contingency plans, consumers become concerned about future availability. The closure of the Strait of Hormuz creates a similar challenge on a global scale, and energy markets react quickly because energy sits at the center of nearly everything we do. Factories need energy, transportation needs energy, agriculture needs energy, construction needs energy, data centers need energy, hospitals need energy. Virtually every modern industry depends on reliable energy supplies. When uncertainty appears in energy markets, uncertainty spreads across the broader economy. Now this is important because silver is deeply connected to economic activity. Many people still think of silver primarily as a precious metal. They picture coins, bars, and investment products. Those uses are certainly important, but they represent only part of the story. Silver is also one of the most widely used industrial metals in the modern world. Every day, silver is used in electronics, telecommunications equipment, solar technology, medical devices, automotive systems, military hardware, electrical infrastructure, and countless other products. In many cases, there is no perfect replacement. Silver possesses unique properties that make it highly valuable in advanced manufacturing. Its conductivity is exceptional. Its reliability is exceptional. Its versatility is exceptional. As a result, silver has become embedded throughout the modern economy in ways most people never notice. Think about your smartphone. Think about data centers powering artificial intelligence systems. Think about renewable energy projects. Think about advanced medical equipment. Think about military communication systems. Silver plays a role in all of them. That means silver demand is influenced by forces that have nothing to do with investment demand. This distinction is extremely important. Gold can spend decades sitting in a vault. Silver often ends up inside products that are actively being used. In other words, Silver is not simply stored. It is consumed. And when a resource is consumed, supply and demand dynamics become much more interesting. Now let's connect this back to the geopolitical situation. The collapse of the Doha peace talks removed one of the most visible diplomatic efforts aimed at reducing regional tensions. Markets generally prefer predictability. Businesses prefer predictability. Investors prefer predictability. When negotiations fail, uncertainty increases, and uncertainty forces decision-makers to reassess risk. A manufacturer that was comfortable maintaining 3 months of inventory may decide it wants 6 months instead. A shipping company may decide to change routes. An energy importer may seek alternative suppliers. An investor may increase exposure to defensive assets. These individual decisions seem small when viewed independently, but collectively they influence markets. Then came the ballistic missile strike on the United States military base in Kuwait. Again, regardless of political opinions, markets immediately began asking practical questions. Could there be retaliation? Could military activity expand? Could additional infrastructure become vulnerable? Could energy facilities face risk? Could shipping disruptions worsen? These questions matter because markets are forward-looking. Investors are not only interested in what happened yesterday, they care about what might happen tomorrow. This is one of the most misunderstood aspects of investing. Many people assume markets react to current events. In reality, markets spend much of their time trying to anticipate future events. Sometimes they anticipate correctly, sometimes they anticipate incorrectly, but they are always looking ahead. That is why headlines alone do not determine prices. Expectations matter. If investors already expect tensions to rise, part of that expectation may already be reflected in market prices. This helps explain why silver has not immediately surged to levels some people expected. Markets may have already incorporated portions of the geopolitical risk. However, there is another possibility. The market may still be underestimating the long-term consequences, and that possibility is what has captured the attention of many analysts. Think about major economic shifts throughout history. Rarely do they happen overnight. Most begin gradually. Small changes accumulate, signals emerge, warnings appear. Then eventually a tipping point is reached where market participants collectively recognize that conditions have fundamentally changed. At that moment, prices can move very quickly. Consider previous periods of energy market stress. The initial reaction is often uncertainty. People debate whether the disruption will be temporary. They debate whether alternative supplies will emerge. They debate whether demand will weaken. But if the disruption proves more persistent than expected, markets begin adjusting to a new reality. That adjustment process is what investors refer to as repricing. A repricing occurs when previous assumptions no longer fit current conditions. For example, if markets assume energy supplies will normalize quickly, but normalization does not occur, those assumptions must change. If markets assume supply chains will remain stable, but disruptions continue, those assumptions must change. If markets assume industrial demand will weaken, but demand remains strong, those assumptions must change. When enough assumptions change simultaneously, prices adjust, sometimes gradually, sometimes suddenly. This is one reason silver has become such a fascinating market. Silver sits at the intersection of multiple powerful trends. It benefits from industrial demand. It benefits from technological expansion. It benefits from energy infrastructure growth. It benefits from investor interest during uncertain periods. Few assets occupy such a unique position. And that brings us to one of the most important questions investors are asking right now. What happens if industrial demand and investment demand begin strengthening at the same time? Historically, silver has experienced some of its most significant moves when both sources of demand align. Imagine a bridge supported by two pillars. One pillar represents industrial demand. The other represents investment demand. If only one pillar becomes stronger, the bridge remains stable. But if both pillars strengthen simultaneously, the entire structure becomes more powerful. Silver's dual identity creates exactly that possibility. Industrial users may seek additional supply because of manufacturing needs. Investors may seek additional exposure because of economic uncertainty. If both groups become more aggressive buyers at the same time, market dynamics can change rapidly. Now, before we continue, if you're finding this analysis valuable, take a moment to like the video and subscribe to John Smith 02. Our goal is to make complex financial and economic topics easier to understand so you can make sense of the forces shaping markets and the global economy. Because what we're discussing today is about much more than silver. It is about how the world works. It is about how energy, geopolitics, manufacturing, technology, and finance connect together to understand why some analysts believe silver could be approaching a major repricing event. We need to look beyond the daily price chart and focus on something that often receives far less attention: physical demand. Most people see a silver price on a screen and assume that number tells the whole story. In reality, the silver market is made up of several layers. There are futures markets where contracts are traded. There are exchange-traded investment products. There are institutional investors. There are retail investors. And then there are industrial consumers who need actual metal for manufacturing. Those industrial consumers do not care very much about financial market narratives. They care about one thing: can they obtain enough silver to keep production running? Imagine you operate a company manufacturing advanced electronics. Your business depends on a steady supply of silver. If your production line stops because necessary materials are unavailable, the financial consequences can be enormous: missed deliveries, lost contracts, reduced revenue, damaged customer relationships. Because of these risks, manufacturers often think differently than investors. Investors can wait. Manufacturers frequently cannot. If they believe supply conditions may become more challenging in the future, they often increase purchases before shortages appear. This behavior is not driven by speculation. It is driven by operational necessity. And this is where physical demand becomes so important. Physical demand often acts as an early warning signal. Before dramatic price movements occur, inventory levels may begin changing, purchasing patterns may begin changing, delivery times may begin changing, industrial buyers may become more aggressive. All of these developments can occur before the broader market fully recognizes what is happening. Think about it this way. Imagine a popular product suddenly becomes difficult to obtain. The first sign is rarely a massive price increase. Usually the first sign is that shelves begin emptying faster. Then stores start limiting purchases. Then delivery times lengthen. Only later do significant price adjustments occur. Commodity markets often behave similarly. Physical availability frequently changes before market perception changes. This is one reason experienced commodity analysts pay close attention to inventories. Inventories act as a buffer between supply and demand. When inventories are abundant, markets can absorb disruptions more easily. When inventories are tight, even relatively small disruptions can have larger consequences. Now consider the current environment. Energy markets are under pressure. Global shipping routes face uncertainty. Geopolitical tensions remain elevated. Manufacturers continue requiring silver for expanding technologies. Governments continue investing in infrastructure and strategic industries. All of these factors influence the supply and demand equation. None of them guarantee a shortage. None of them guarantee higher prices. But collectively they create conditions that deserve attention. Another factor often overlooked is the growing role of technology in silver demand. Over the past decade, technological advancement has accelerated dramatically. Artificial intelligence infrastructure has expanded. Data centers have grown larger. Communication networks have become more sophisticated. Energy systems have become increasingly electrified. Renewable energy installations have continued expanding. Many of these developments require significant amounts of silver. This is important because demand generated by technology tends to be structural rather than temporary. A structural trend is different from a short-term trend. A short-term trend might last months. A structural trend can last years. When societies build new infrastructure, that infrastructure often requires ongoing maintenance, expansion, and replacement. As a result, demand can persist much longer than many people initially expect. Now combine these long-term technological trends with geopolitical uncertainty. Then combine them with energy market disruption. Then combine them with potential inventory accumulation by manufacturers. Suddenly, the silver story becomes much larger than a simple precious metals discussion. It becomes a discussion about the future of industrial development itself. This is one reason silver is sometimes called a metal with multiple personalities. At times it behaves like an industrial commodity. At times it behaves like a precious metal. At times it behaves like both simultaneously. That dual nature makes silver extremely difficult to analyze using a single framework. Investors who focus only on economic growth may miss the investment demand story. Investors who focus only on precious metals may miss the industrial demand story. Understanding silver requires looking at both. Now let's talk about another important concept, market psychology. Financial markets are driven by human behavior, and human behavior is not always rational. People tend to pay attention to what has already happened rather than what is developing. They focus on visible trends rather than emerging trends. They become comfortable with current conditions and often underestimate how quickly those conditions can change. History provides countless examples. During periods of stability, people assume stability will continue. During periods of growth, people assume growth will continue. During periods of calm, people assume calm will continue. Then reality changes. Markets eventually adjust, and when they do, the adjustment can be much faster than expected. This does not mean silver must experience a dramatic move tomorrow. That is not the point. The point is that market perception can change rapidly once a sufficient number of participants begin seeing the same risks. Imagine standing in a theater. At first, only one person notices smoke. Then a few more people notice. Eventually, everyone notices. The situation itself may not have changed dramatically during those few minutes. What changed was awareness. Markets often work the same way. The difference between a quiet market and an active market is frequently a change in collective awareness. This brings us back to the central question. Why is silver still near $74? One explanation is that markets remain uncertain. Participants are still evaluating the significance of recent events. They are still debating potential outcomes. They are still determining whether disruptions will prove temporary or long-lasting. Another explanation is that financial markets frequently lag physical realities. Investors often wait for confirmation. Industrial buyers often act before confirmation. That difference can create periods where physical demand appears stronger than market sentiment. Eventually, those two realities tend to converge. The timing, however, remains uncertain, and timing is often the most difficult part of market analysis. No one knows exactly when market perceptions will change. No one knows exactly when new information will emerge. No one knows exactly how governments, businesses, and consumers will respond. That uncertainty is unavoidable. But uncertainty does not mean analysis is impossible. It simply means we focus on probabilities rather than certainties. Now let's consider several possible scenarios. The first scenario is de-escalation. Diplomatic efforts succeed. Shipping routes reopen. Energy markets stabilize. Supply concerns ease. Under that scenario, some of today's fears could diminish. The second scenario involves prolonged uncertainty. Tensions remain elevated. Energy markets remain volatile. Manufacturers continue building inventories. Businesses remain cautious. Under that scenario, silver could continue attracting attention from both industrial users and investors. The third scenario involves further disruption. Supply chains become more strained. Energy costs remain elevated. Strategic competition intensifies. Under those conditions, markets may need to reconsider many existing assumptions. Notice something important. These scenarios are not predictions. They are frameworks. Good analysis focuses on possibilities rather than pretending certainty exists. And right now, one thing seems increasingly clear. The silver market sits at the center of several powerful global forces: technology, energy, manufacturing, geopolitics, investment behavior, supply chains. Each of these forces matters individually. Together, they create a remarkably complex and potentially significant environment. This is why some analysts continue describing silver as one of the most misunderstood markets in the world. Many people see only the price. Few people study the forces behind the price. But the forces behind the price are often where the most important information resides. As we move deeper into 2026, investors should pay attention not only to headlines, but also to trends. Watch energy markets, watch industrial production, watch inventory reports, watch shipping developments, watch geopolitical events. These factors may provide better insight than day-to-day price fluctuations, because the biggest market stories rarely emerge overnight. They develop gradually. Signals appear, patterns form. Then eventually the broader market recognizes what was happening all along. And that brings us back to the title of today's video. Why are silver prices still at $74 ahead of a massive market repricing? The answer may simply be that markets are still processing an extraordinary combination of events. The collapse of the Doha peace talks, the ballistic missile strike on a United States base in Kuwait, the closure of the Strait of Hormuz, the possibility of higher energy costs, the ongoing growth of industrial demand, the increasing importance of advanced technologies, the potential for changing investor sentiment. Each factor matters. Together they create one of the most compelling silver market environments in years. Whether a major repricing ultimately occurs remains uncertain, but the forces capable of producing one are clearly visible, and that is why investors around the world continue watching silver so closely. Because sometimes the most important market story is not the move that has already happened. Sometimes it is the move that the market has not fully recognized yet. Thank you for watching John Smith 02. If you enjoyed this analysis, make sure to subscribe and turn on notifications so you never miss future discussions on silver, gold, economics, geopolitics, and the global trends shaping financial markets. I'm John Smith, and I'll see you in the next video.